Hey, what's good, self-direct investors? I hope you're all doing great, and I want to welcome you back to my channel. If you're new here, my name is Jordan. I'm the mind behind Make More Capital, and today we're going to cover some recent MSO and LP earnings. So before we jump in, if you enjoy this video or you learned something, please just leave a like on it as it really helps out my channel. And then of course, if you want to learn how to take advantage of this generational investment opportunity, make sure you subscribe below so that you don't miss any future videos. And there's plenty of content for you to go back, rewatch, and educate yourself, as I've tried to put all the news developments and facts in one place so that you can learn about the industry, identify some companies that you think will do good in the long run, and then take advantage whenever you're ready. But we're going to start with Curaleaf, as they reported earnings yesterday at 5 p.m. after market closed, and they crushed. So we're just going to start off on this high note with their first quarter 2021 revenue of $260 million, up 170% year over year from Q1 2020 and 13% sequentially. Their first quarter adjusted EBITDA reached $63 million, which is another record for them, up 213% year over year from Q1 2020 and up 16% sequentially, achieving a margin of 24% there, with revenue guidance for the second quarter of 2021 anticipating $305 to $315 million, which is a big jump from 260. So this is impressive to see, and it really set the tone for the top tier MSOs. Now, if we look at the total revenue, we can see compared to Q4 of 2020, there was a 13% sequential increase. But again, compared to Q1 2020, which was last year at this time, $260 million in revenue, up from $96 million, and 170% change is massive. So this really helps set the MSOs apart from the LPs. With their gross profit before impact of biological assets up to $128.4 million, up 16% from $110 million in Q4, and up 145% from $52 million in Q1 1 year ago. So that's pretty impressive, bringing their total gross profit on cannabis sales up to $128 million again, up 17% from $109 million last quarter, and 287% up from $33 million, again, Q1 2020 just a year ago. So that brings their gross margin on cannabis sales up to 49%, so close to 50, but as we can see, they've grown them from 43% up to 48%, up to 49%, so they're growing those margins. Plus, their adjusted EBITDA did increase to a record amount of $62.6 million, up from $53.7 million last quarter, and $20 million, a 213% increase from a year ago. So that's impressive. Now, of course, as they are expanding into New York, New Jersey, growing their cultivation on the east, as well as introducing adult use sales in Arizona, where they have a large footprint, they did suffer a net income loss. Again, $17 million spent this quarter on operations. Mind you, they reduced that from $35 million in Q4 of 2020. And although it is a little bit more than what they spent Q1 2020, again, there's a lot more going on that they have to prepare for in the future, bringing their net income loss to just negative 0.3 cents, which, could be a lot worse. You've seen that from Canadian companies. So lots of positives here. Now, a few more things to highlight. They closed the quarter with 102 retail locations and 1,992 wholesale partner accounts. I don't know much about how the wholesale partner accounts works, but I'd like to learn more, as it's likely similar to what Cresco Labs is doing and Verano, some of these other MSOs. So I'm just going to try and find out more information about that, but interesting that they noted that. Launched Select Squeeze, a THC-infused beverage enhancer, to date the widest cannabis product launched in the nation, available in 14 states, with retail revenue growing by 14% sequentially and 231% year over year, with wholesale revenue growing 12% sequentially, 254% year over year. So those are some numbers that we like to see. In post-first quarter highlights, successfully closed the acquisition of EMAC, Europe's largest vertically integrated independent cannabis company, while securing $80 million in new capital, not from equity or dilution, but new capital in the European business subsidiary from a strategic investor to support the future growth. So that's helpful for current investors. Plus, they've opened 4 new stores since March 31st, 2021 in Illinois and Pennsylvania, bringing total retail locations to 106. So if we break down their revenue to retail revenue and wholesale revenue for the most part as of right now, as we can see, retail leads the way, but they are growing their wholesale revenue by a large amount. And just if we compare this growth from last year to this year, it's incredible. And obviously these numbers up here highlight exactly the difference. But going from 56 million to 187 million over year, 96 million up to 260 total is very impressive. And if we look at how much they're spending to make these profits, let's look at just Q4 last quarter and Q1 this quarter. They spent about 119 to make 229, and this most recent quarter they spent 131 million to make 259 million. So as much as they are increasing their revenues, it seems as if they're doing a good job at reducing the amount that they're spending, as this, 128 million is pretty much almost half, representing their 49% profit margins there. So love to see that. And then if we just scroll down to here, their net income loss of 17, subtracting all these other expenses for an adjusted EBITDA of 62.6. I just wanted to read through here. The first quarter of 2021 net loss attributable to Curaleaf Holdings Inc. was 17 million compared to a net loss of 15 in the first quarter of last year. The net result was primarily impacted by an income tax provision of 31 million due to increased gross profit in certain of the company's subsidiaries that are subject to the restrictions of 280E of the Internal Revenue Code, and to a lesser degree by an increase in the interest expense related to lease liabilities due to the expanded number of retail sites. So clearly, as we can see, 280E does continuously play a role in affecting these results for these companies, but nonetheless, I was very impressed with this out of Curaleaf. So I wanted to highlight this first because obviously we're expecting some of the top tier MSOs to do bigger numbers. On top of that though, Harvest Health did report some very healthy numbers. First quarter revenue was up to 88.8 million, up 100% from the first quarter of 2020 and up 27% sequentially from Q4. They did suffer a net loss before non-controlling interest of 23 million, which sounds similar to what Curaleaf just explained with 280E from their subsidiaries, compared to 7.4 million in the fourth quarter of 2020. Their adjusted EBITDA was 26.9 million in the fourth quarter, up 196% compared to 9.1 million in Q4 of 2020, just last quarter. Mind you, the bold prediction out of this is that their 2021 revenue target, so coming out of the next 3 quarters, will get them to at least 400 million in revenue. And I imagine that this is due, obviously, because of on January 22nd, 2021, Harvest recorded the first recreational cannabis sale in the state of Arizona as its Scottsdale location. Harvest began serving adult use customers in addition to medical patients at all of its 15 dispensaries on January 22nd. So that is a big contributor to their increased revenue. And I do believe their target for revenue was 87 million, and they did do 88.8, so they did increase and actually beat their own expectation. While recent developments include Harvest opening 2 new medical retail dispensaries in Florida on May 5th and 6th, they announced a settlement reached regarding a grower processing permittee, Agromed Industries of PA LLC, but on May 10th, Trulieve announced its planned acquisition of Harvest, which came as a big surprise yesterday morning. Each Harvest shareholder is expected to receive 0.11 shares of Tilray for each Harvest share, representing total consideration of approximately 2.1 billion. The implied price of Harvest share is equal to $4.79 US dollars, which equates to $5.80 Canadian, representing a 34% premium to the May 7th, 2021 closing price of the Harvest shares. So their outlook is very positive, as they're raising its full year revenue target to at least 400 million. Reported gross margins are expected to be at or above 50% and will likely to continue to fluctuate from quarter to quarter. But 50% is where these companies want to be. And if we look at the year-over-year comparison, we can see that in Q1 2020, Harvest brought in $44.2 million in revenue while spending $26 million to do so, leaving them with a profit of $18.1 million. Now, that's still a great gross profit for a small, fast-growing company. However, it is below the 50% profit margin standard threshold that they've been aiming for. And as we can see in Q1 2021, they brought in $88.8 million. And although they spent $40.9 million, obviously preparing for stocking up stores for adult use sales, also expanding into Florida and Pennsylvania. So without a doubt, they're spending more money, which represents about 14 million more than they spent last year. But even with more spending, the increased revenue has helped them bring in a gross profit of 47.9 million, which represents 53% of 88.8 million, increasing that gross profit margin above that 15% like they've been looking for. So that's great to see. Well, compared to an operating loss of 25 million a year ago, they managed a positive operating income of 13.3 million, which is great to see. But after everything is said and done, a net loss of 23 million, which equates to a loss of negative 6 cents per share. But again, this is the cost of preparing all of your stores for adult use and expanding your footprints in Florida and Pennsylvania, solidifying your footprints in states. And on top of that, their net loss, after that net loss, so they still managed a positive EBITDA of 26 million. Their first positive one, well, not necessarily their first positive one, but quite a gain compared to negative 4.8 a year ago. So nice to see this out of Harvest. And again, just to highlight here, their main, I think the best thing out of them to show is their gross profit margin in the first quarter was 53.9% compared to 41% in the first quarter of last year and 44.8% in the fourth quarter of 2020, which makes them an attractive purchase for Trulieve. And that is what brings us to one of the big headlines we saw early yesterday to start the week, Trulieve announces the largest U.S. cannabis transaction. Acquisition of Harvest Health and Recreation, Inc. creates the most profitable multi-state operator in the world's largest cannabis market. And the combined entity would provides consensus 2021 estimate revenue of $1.2 billion, which I believe is more than Curaleaf was anticipating. So this heats up the competition. You gotta love to see it. Under the terms of the arranged agreement, shareholders of Harvest will receive 0.11 of a subordinate voting share of Trulieve for each Harvest subordinate voting share held, representing total consideration of approximately $2.1 billion based on the closing price of Trulieve shares on May 7th, 2021. So, Trulieve, a leading multi-state operator with a focus on the northeast and southeast regions of the U.S., and Harvest, a leading multi-state operator with a focus on the west coast and northeast regions in the U.S., have built deep, vertically integrated operations in their key markets, becoming leading operators in the United States and the world's largest regulated cannabis market. Upon completion of the transaction, as well as the closing of other previously announced acquisitions by Harvest and Trulieve, the combined business will have operations in 11 states, comprised of 22 cultivation and processing facilities, with a total capacity of 3.1 million square feet and 126 dispensaries, serving both the medical and adult use recreational cannabis markets. And I think the biggest thing to highlight here is that you're going to have Trulieve, which is the dominant force in Florida, and then you're going to have that dominant footprint in Arizona, where adult use has just opened up. Key highlights and benefits include increasing scale across our hub markets through the creation of the largest U.S. cannabis operator on a combined retail and cultivation footprint basis, creates the most profitable U.S. MSO with combined 2020 adjusted EBITDA of $266 million and combined 2021 estimates consensus adjusted EBITDA of $461 million, delivering an unparalleled platform for continued growth. Delivers a superior existing retail and distribution model from a robust retail network of 126 dispensaries across 11 states. The combined company will have leading market shares in Arizona and Florida. Strong and expanding multi-state presence bolsters Trulieve's expansion in U.S. Northeast and Southeast hubs in Florida, Pennsylvania, and Maryland, and establishes a Southwest hub in core markets including Arizona, where recreational adult use of cannabis was just legalized. Optimizes the nationwide presence through well-established retail and wholesale channels across markets, as well as the ability to reach an estimated total addressable market of US $19.3 billion in 2025 estimates given by ArcView. Adds premium brands to Trulieve's portfolio of in-house brands and national brand partners with a successful line of products across multiple form factors, leverages expert operating teams and best practices from each of Trulieve and Harvest, enhancing operational excellence by combining unparalleled knowledge of and success in winning state license application processes and the ability to rapidly bring operations to market. And accreditive transaction reinforces Trulieve's leading financial metrics by reinforcing superior financial performance relative to peers through industry-leading margins and strong projected profitable growth. Now, the terms of the transaction: each Harvest shareholder receives 0.11 of a Trulieve share for each Harvest share, implying a price per Harvest share of US $4.79, which is Canadian $5.80, which represents a 34% premium to the May 7, 2021 closing price of the Harvest shares. Now, what do I plan to do? Obviously, I invested expecting Harvest to continue growing, but now that they're going to be bought, I'm quite happy knowing that I will own Trulieve in time. But what I actually plan to do is, since Trulieve has officially valued Harvest at $4.79 USD, which equates to $5.80 Canadian, that gives us reason to believe that we can expect Harvest shares to hit $4.79 USD soon, or $5.80 Canadian, as that would be the value determined by Trulieve when the deal goes through. So if that is the case, what I plan to do is sell 700 of my Harvest shares to lock in $4,000 in profit, get out a bit of cash that I can use to buy dips in some of my other MSOs, and then just keep my 2,000 Harvest shares to convert to 220 Trulieve shares and keep 10K book value invested in Trulieve. So that is my plan. Obviously, no rush to get into that, as there's lots of time for this to develop, but I just wanted to share with you what I plan to do, and this is very exciting news out of the US. So MSOs do not fail to disappoint, as they are bringing the action. Now, what we're going to do, though, actually, sorry, I wanted to show you this one thing that I brought and pulled up. This is from MJ Stock Trader, Trulieve acquisition of Harvest conference call thread. That was for yesterday. However, this is a nice visual that helps bring it all together. We can see all of what Trulieve has, all of what Harvest has, and what the combined new entity will be able to bring to the table, especially as one of the top 4-tier MSOs that are aiming big. So it's going to be interesting to see how this helps Trulieve compete against Curaleaf, GTI, Cresco Labs. Mind you, they're all different companies aiming at different things. So I don't see why, with the amount of population the US has, that they're not all going to manage to do great things in time. But just wanted to show you that. You can pause here if you want to take a look. But we're going to jump over to Canada to check out some less than stellar recent earnings from Village Farms International and Kronos Group. And if it wasn't clear before, this should help make it clear and just highlight that US MSOs and Canadian LPs are not the same. The US has a lot more people to work with, looser regulations in certain states, whereas in Canada, we just don't have the population. And the one thing that we've needed is stores, which are coming in the coming months. But again, that takes time to implement. So it's just so important to understand what you're investing in before you do, and also to lock in profits when you can, in order to take time to formulate a better, more solid plan so that you can hold and also sleep at night. But Pure Sunfarms achieves third consecutive quarter of sequential growth in retail branded sales of 20% or greater. And just wanted to note here, they're happy to tout Pure Sunfarms once again the top selling dried flower brand with OCS for the first quarter. Main thing to highlight though is that OCS sales represent like 1/5 of the total sales. Most Canadians want to buy from retail locations where they can actually go in and shop. They're happy to do that. So for them to tout this, it's like, yeah, well, we are the top selling flower brand for the outlet that sells 1/5 of the total sales. It's like, okay, you're painting a picture. That's nice, but not necessarily fully representative. Now, Village Farms consolidated financial summary. As we can see, total sales up 63% from last year, went from 32.1 million in 2020 to 52.4 million in 2021. Now, as we can see, a large portion of this is produce. This is from tomatoes, as Village Farms International is a vegetable distributor. But as we can see, comparative to 2020, which when they didn't own their Pure Sun Farms 100% of it, they're up to $17.4 million. So this definitely shows a nice increase. So we're just going to look at the Pure Sun Farms financial summary. Total gross sales. So this is before subtracting cost of goods sold. They did 24.3 million in US dollars, up from 15.7 million US dollars in 2020. But after subtracting goods sold, so net sales, they managed 17.5 million, up from 13.1 million, which again though, year over year, 23% is not huge. So that kind of takes away from what they're touting in the beginning, saying, oh, the most dried flower sales, 20% market share. It's just, the reality check is that their margins have gone from 52% to 29%, and so that is likely why there was such a sell-off yesterday, which is not ideal. Doesn't mean that Village Farms can't turn this around, but it really just again highlights the inability for LPs to see growth in the 3 digits, just because we just don't have the people. If we look at their revenue streams from 2020 compared to 2021, they were a lot more focused on wholesale last year, 52.7%, with 47.3% coming from flower, as opposed to this year where they've put in a good portion of their efforts to 2.0 products, and they've reduced a lot from wholesale and pushed that into flower. Mind you, here's the thing, with Village Farm, they are selling low cost, low price cannabis in high quantities, trying to get rid of probably their inventory. The main thing is that that's not going to bring them in a lot of money, and that's probably attributing to their lower margins. And on top of that, Canada just has so much cannabis. There's an oversupply that wholesale is likely just not as an effective of a revenue avenue anymore. We don't know that, but clearly whatever they tried did not necessarily work for them. But the good news is after this drop, it's made them considerably cheaper, as Village Farms is now trading under a market cap of $1 billion. And total, year over year, that puts them at about a 5x price to sales if you include their vegetables and cannabis. But, this officially makes them cheaper. And so it's so important to buy low when no one else is buying, and then sell high, not to buy high and sell low when you start to second guess why you bought in the first place. But over to Kronos, we're going to look at their first quarter results, and I just want to point out that they're sitting quite low, very far from their all-time highs. Likely they're never going to get back to there. But one thing to point out is that Kronos has a market cap of $3.27 billion. We're gonna go through these earnings, and you can be like, why? That's a great question. I don't know. It makes no sense to me why I don't own Kronos. But I mean, we know that Altria invested $2 billion into Cronos a couple years back. And so that is the only reason that they're valued at $3.27 billion, not justified by their operations, their revenue growth, or their sales or anything. And this again is why I see Cronos as a shell for Altria. Altria just wants to use Cronos to develop their vape technology, because obviously tobacco companies want to go from having their consumers actually smoking cigarettes to a new form of healthier vape smoking, obviously because they still want to be able to make money. But that's the only thing I see Cronos as, is a shell for Altria. And personally, I do not want tobacco taking over this industry. But just to highlight again, a company worth $3.2 billion, let's see how much revenue they made in this quarter. $12.6 million. What? Up from $8.4 million in this quarter of 2020. So again, a 50% increase, but it's an increase, when you're working with such small numbers, 8 million up to 12 million, for gross profit loss of 2.9 million, which is less than they lost last year, 6.4 million. So again, they're not losing much money. It's not like they're blowing a lot like Canopy or Aurora are, but adjusted EBITDA loss of 37 as well. So, comparative EBITDA loss to the US MSOs, mind you, they're not increasing their revenues at a rate anything close to those MSOs. And profitability is the main thing you want to be aiming for. They're far from it. But the main thing is that they have cash on hand, again, because Daddy Altria has just given them money to put on their balance sheet, which keeps them afloat and alive as a company. So that's also that's what I see out of Cronos. I don't know if any of you see something different and you think they're a great company, let me know in the comments. I'd love to know why you think so. But then if we also look to see what their worldwide operations are, where cannabis flower net revenue, so worldwide operations outside of the US. So the rest of the world, this includes Canada. Let me reiterate, this includes Canada and European medical. Net revenue of just 10 million, up from 6.2 million, a loss of 4.1 million, down from 7.5 million, and an adjusted EBITDA loss of 22 million, down from 29 million. So again, not much to point out here, but just pointing out that there's little revenue growth. Well, no, there is revenue growth, but not in the quantity that we want, but there's very little actual profitable growth, like growth and profitability or anything like that. And so that just, to me, represents a company that is not necessarily badly managed, but it has its own purpose, and it does not serve, but the purpose, though, does not serve shareholders. That's the way I would view it. And then again, just to highlight, Cronos has never made it all the way back up to these all-time highs, because this was just hype. This was euphoria, hysteria, not real. But hey, if you were fortunate enough to buy here and sell here, that is how you do investing, right? So just lastly, to point out, on top of the topic of bad management or badly run companies, so important as a shareholder to know what you're investing in so you don't get caught holding bags for years. And I just want to point out that I always talk a lot of crap towards Canopy, Cronos, and Aurora, mainly because in the past they've had very bad management. And bad management leads to unhappy shareholders because you do not see a return on your investment in time that you're expecting. But just to highlight, cannabis firm Cronos CEO gets a $12 million bonus in partial year pay. So Canadian cannabis producer Cronos Group paid CEO Kurt Schmidt more than $10 million in salary and other compensation in 2020, according to the Toronto-based company's recently disclosed proxy circular, even as the operation continued to lose money. Schmidt's compensation reflects a salary and bonus that covers only the part of the year he was chief executive in 2020, roughly 4 months between early September through December. The 64-year-old executive's total pay was 217 times more than the median compensation for the cannabis producer's other employees that year, the regulatory filing states. Executive compensation is a growing area of interest in the cannabis industry, which has seen executive pay at certain large cannabis companies skyrocket, even for publicly traded businesses reporting significant losses. For instance, Smith Falls, Ontario-based Canopy Growth paid David Klein about $33.8 million, including salary, bonus, stock options, and other compensation for his first 3 months with the company last year. Canopy reported a Canadian $1.3 billion loss in the same period. Executives at rival producers Aurora Cannabis, meanwhile, were rewarded with millions in bonuses and raises last year despite mass layoffs and a loss exceeding $3.3 billion. Cronos appointed Schmidt as CEO in September 2020, and Cronos reported an operating loss of $58.4 million and net loss of $111 million in Schmidt's first full quarter at the helm from October to December 2020, in addition to adjusted EBITDA of negative $53.9 1 million. However, Cronos exceeded analyst expectations in sales with net revenue of 17 million, with the compensation consisting of a salary of 520,000, stock awards to 2.8 million, option awards of 7.35 million, and incentive plan compensation of more hundreds of millions. Is it wild how much CEOs make? Yes. Should it be illegal? No, because just like your boss is willing to pay you for the work you put in, their boss is willing to pay them for hitting certain milestones. The thing is, this is something that you cannot control, so there is absolutely no benefit to you by focusing your energy getting angry or being upset about a past bad investment. The best thing you can do is, take any bad investment in the past as a lesson. And remember that going forward, the only person you can control is yourself. And that being said, try your best to do your due diligence. Make 10 minutes or 20 minutes a day just to check in on the company or your plan and make sure that your plan is something solid that you want to stick to for a long time. I learned through the Canadian market, but I think I got lucky with the FRIA, and I did manage in February to lock in some profits. I wish I would have done more, but again, it's all about learning your lesson and looking back in hindsight, not seeing it as a bad thing, but seeing it as a lesson and, learning from it. That way you can do better as an investor going forward. But that is it for today's video. So let me know in the comments what you think about the US MSOs versus the Canadian LPs. I will not be doing a video tomorrow for Wednesday. However, I'll be coming out with another one on Friday covering Green Thumb and Trulieve's earning releases. So very exciting to see these MSOs continue to see strong growth. And nonetheless, if you enjoyed this video, please leave a like on it. Subscribe below if you don't want to miss any future videos. And I will catch you on Friday with another video. Have a great day, everybody.